Is with us and as founder of Abacus Asset Management, and Nilesh Shah, the CEO of Kotak Asset Management Company. Gentlemen, thank you very much for joining me right now. Nilesh, first thoughts,
Thank you.
The market went up and then it's kind of relaxed, it's given all its gains.
I think market is looking at the details. First there was a euphoric reaction, then now the details are coming into place. The part about the budget is that the revenue assumption in terms of nominal GDP growth or tax collection is reasonable. Nominal GDP growth of 11.6 looks achievable. Taxation growth of about 50% vis-a-vis 20% achieved this year also looks feasible. The only limitation over here is that because this was vote on account interim budget, there's no details about capital spending. And the capital spending is growing at about 4-5%. Whereas the other revenue courtesy, that 75,000 crore spending, is growing at about 20%. So the fiscal deficit number today at 3.4% is without major capital expenditure.
Yeah, that would be a worry.
Sunil, your first thoughts, and 15 points left on the Nifty now. It's a big sell-off, almost flat. Your sense?
So I think it's basically a very regular feature, on a budget day. The swings are very wild, and actually typically fine prints, you don't figure out what is there, what is not there. As rightly said by Nilesh, the capital expenditure figures are a little bit disappointing, specifically when you're looking at kickstarting the economy, and particularly given the fact that the finance minister was talking about the 10 dimensions, which were all towards creating of infrastructure and so on and so forth. Having said that, I think it's an interim budget. Not too much was expected. In the given circumstances, the fact that a lot of relief has been given to both urban as well as rural population, anywhere between 6,000 to 10,000, I think that should be a little bit heartening, and that should be taken a little bit positively. On the whole, I think it's been sort of a non-event, and I would say that the markets did react positively. Maybe, it's a normal thing that when finally people realize that it's okay, it's status quo, you tend to move in yo-yo. We also have to remember the fact that this is the first day of the new series, and positions were light. So in expectations and during the period when the budget was on, some positions were built up, and the intraday traders maybe are squaring up those positions.
Sunil, I'll have to request you.
Reading the fine print. So it's the first day of the new series, and
may I request you to just hold on? The finance minister is speaking yet again, addressing the press along with his secretary. So just listen in if he's clarifying something.
खड़े हैं लोग, उनकी सबसे अधिक चिंता करेगी ये सरकार. जो मध्यम वर्गीय परिवार हैं, उनकी चिंता करेगी ये सरकार. और लगभग जो विषय आज बजट में उजागर करे गए, वो एक प्रकार से समाज के हर वर्ग को छूने वाले.
Actually, since he's just re-explaining the basis of all the giveaways and the packages, we will get back when the question-answer session starts, because then perhaps we'll get some clarity on when the taxes become applicable. Do they become applicable after the government returns, or do they become applicable on April 1st? Will taxes have to be cut by the by the companies while paying incomes under 5 lakh? Or will they have to cut the tax and then claim a rebate? All those doubts are still, with us, and our reporters are there to ask those questions of the secretaries and the minister. Nilesh, real estate, is it time to buy them? There are some benefits.
Definitely. Real estate has been going through a cleanup process courtesy RERA. The first time we are seeing large industrial houses now entering into real estate sector on a serious basis. Second, the basic model of real estate in a very lighter vein was to put a rumal on a plot and hope that by creating shortages you will get higher prices. Now I think we are going to factory model. You bring a plot of land, build building, sell it and move it out. Third, in this budget there are certain provisions which will be beneficial to real estate sector. For the developers, the unsold inventory period has been extended from 1 year to 2 years. Second, there is proposal that GST Council, there will be reduction in border home buyers. Third, there is a step taken to increase the demand. by providing tax exemptions to middle class taxpayers. Second, your capital gains has moved from house to two house. There is also relaxation in terms of notional rental income on second SOP. Put all these things together, real estate sector should bottom out. Obviously, it's location specific. Where there is economic growth, real estate will move faster. Where there is excess supply, real estate might move a little slower. The overall belief that there will be beneficial impact to the real estate sector, and that will reflect into real estate stock as well as construction stock.
Sunil, same question on real estate to you. I mean, a lot has been, there's one space you can unambiguously point to and say, well, a lot has been done for is real estate. Your thoughts in terms of what the measures will do for the space, for investors, everyone?
Sure. So I think my view is that yes, the sector is getting a little bit more organized with long-term, I would say good quality corporates getting into the sector. Having said that, I would say the sales, particularly on the residential side, are very, very muted and supply is very high. So I would still be a little bit apprehensive about investing in sort of real estate stocks. At the same time, I am positive on the sector, and I would say that maybe housing finance companies, after the sharp fall post the NBFC upheaval, are a better way to play it. Because the mortgages are still quite low in percentage terms in India. You are getting good benefits from the government in terms of interest rates, subvention, and so on and so forth. There are tax benefits, and I would rather play the sector through housing finance companies than buying into real estate developers. There are some real estate developers which are focusing more on the rental model. I think they are in a much better position than companies which are only in the residential development space. So my preference would be to go in for housing finance companies rather than real estate stocks.
That should be music to Nilesh's ears as well. Housing finance companies have been at the heart of the debt market problem. Do you think that gets somewhat addressed, at least sentimentally?
So again, if we see debt market problem, those housing finance companies or those NBFCs which did not have liability franchise, they suffered the maximum. The blue chip housing finance companies had no problem, and there was no crisis there. My guess is that in the NBFC space there will be diversion. One set of companies who have no governance issue, one who has built liability franchisee, third whose growth is not extraordinary but measured and moderated. Those guys will have no trouble, but company specific issues can still persist. The issue is not about just getting liability to fund your assets, but it's also about what kind of quality of assets you are building. Is it home loan or is it developer loan? So the issue will be more company specific. As we analyze and as the numbers come in, Nilesh, the yield has now gone to 7.37. I'm not saying that's big, but we started off at 7.26 when the budget was being read, the yield on the 10-year, I mean. And now looks like the market is beginning to worry a bit about the assumptions on which this 4.73 net borrowing number is built. If it's built on an assumption of a tax collection that doesn't come, because the GST tax assumption apparently is 21%, which is a little worrisome. We may not reach it. This year, year to date, the GST growth has only been 6%. Maybe there are compliance glitches. Maybe it will be better next year. But even then, a 21. This year, the FY19 BE assumption was 23%. But we have managed only 6%. And of course, there were GST tax cuts as well. Now the assumption for the next year is some 21%. That apparently is not
just to come back to Lata, you were discussing a point with guests earlier about the new government, whatever shape and form it takes, will have right to decide what to do. But prima facie, it will be very difficult for them to do away with some of what has been announced, right?
Yeah. So politically, I don't think you can change anything, because taking away a benefit of 6,000 rupees...
Giving more is okay, but taking away is harder. Nilesh, how do you...
Undoubtedly, what you have given will not be withdrawn, because it will look very, very difficult. But on the taxation side, compared to FY19 over FY18, the growth is about 19.48% in revised estimate over previous year's actual numbers. And FY20 over FY19 is coming at 14.89%. So my guess is that if we are looking at 21% growth in GST collection, then the income tax and corporate tax collection probably will be almost flat.
13%.
That math doesn't tally, because your revenue, the net tax revenue is 17.05 lakh crore, and the previous year was 14.84, and the before that was 12.42.
Okay.
So there is some markets worry will not be about the revenue estimates. I think markets worry will be about able to sustain small things collection, where you are assuming 1,30,000 crore collection, and there is also a drawdown of cash balance of 51,000 crore. So is this numbers good enough? If they are indeed achievable, and they have been achieved in FY19, then the borrowing program will be sustainable. The other worry, Lata, is that this year almost 2,85,000 crore came by way of open market operations, and this was necessitated as our FX reserves were dipping. Next year, my guess is that FX reserves will be increasing. Then RBI won't have ability to do this open market operation.
To the same extent.
And the banking system is still SLR surplus. It's not SLR deficit. So how do we excite banking system and non-bank players to participate in the borrowing program in absence of the open market operation? That is what is weighing in the debt market.
Okay. No, actually, this arithmetic on how much is the assumption in indirect taxes was something which a guest told us. I still don't have that number myself. So we will have to see.
A little bit different.
Okay. Okay. Your the indirect tax assumption is?
I haven't got into that detail. I was more at top line. So 17.05 lakh crore in FY20, 14.84 in revised estimate, and 12.42 in FY18 actual.
Okay, yeah, that's the tax revenue assumptions. I'll just do the math in a minute. But Sunil, you know, if the cost of capital rises anyway, somebody has done the math, and it is rising now at 7.37. How does that change the texture of the stocks that you will pick up? Will you still pick up NBFCs?
So my view is that, you know, interest rates don't look like rising. You know, obviously today's 10 basis points is a reflection of concern over, or maybe apprehension about the fiscal, you know, maths as we speak. However, my view is that with rupee stabilizing, and today rupee movement has been pretty stable, and also the fact that globally the concerns about, you know, interest rates rising in the US or some of the other economies also residing, we might start to get flows back into our fixed income market. And, you know, there is a very small sort of gap between what the government intends to raise and what the street believes that the government will be able to raise. And my view is that stability in the rupee can, you know, sort of lead to flows coming from abroad as far as our fixed income market is concerned. So I would still believe that we are heading into a more muted kind of an interest rate scenario. And, you know, I would stick my neck and say that, you know, maybe we are looking at like around 7% as far as 10-year G-Sec yield is concerned by the end of calendar 2019 rather than being higher.
Okay. Well, point taken, because there is an overall depression of yields looking at the global inflation scene and the crude price scene. So perhaps cost of capital will not be such a big worry unless we muck it up seriously. I take your point. At the moment, if you look at the actuals of last year and the budget estimate, revised estimates of the current year, the tax revenue should have grown by 19.3%. Now, I'm not very sure. We still have 3 months to go, and whether this is an aggressive advanced tax assumption for the fourth quarter that's leading to it. We have to check up with economists whether they consider it, you know, okay, whether it's kosher with them. But the next year's tax assumption over this year's revised estimates is 14.8%. So, well, that looks less than the collection this year, and therefore should not be such a big ask. But I'm wondering if 19.3 is something which people are able to absorb just yet. We'll have to ask people, because it's very close to the budget estimate, and the budget estimate was not met if you looked at the first 8 months of collection on indirect taxes. So why are you assuming the revised estimate to be equal to the budget estimate? There's hardly any change. It was 14.80 lakh crore, and now they've assumed 14.84. Which means your budget estimate is lower than your revised estimate when the first 10 months did not give you that confidence in terms of tax collection. So we'll have to wait and see.
The FM's number he did mention that the average tax collection this fiscal is about 97,000 crore.
Yeah, but the asking rate is 1.1 lakh crore.
And if the new Jan-Feb March goes at slightly higher rate, then probably the shortfall will be not as much as was expected, let's say on 31st December. There could be some little bit
absolutely
of surprise.
Right. That the shortfall will be bridged, but they are assuming an increase
the
over
second
budget.
advantage which is coming in is that because of the revision in GDP growth in FY17, we have seen the denominator expanding. So on that denominator, your fiscal deficit number will start looking
That is your percentage of fiscal deficit.
Absolutely.
I am speaking of actual tax revenues. The budget estimate was 14.80 lakh crore. The revised estimate is 14.84. I mean, how have you revised higher the tax revenue when the first 9 months, I think we have till December, was way lower? I mean, the asking rate for GST was 22, and what we actually got in the first 9 months was 6%. Also because GST rate itself was revised lower. So I really want to question this 19% assumption of tax growth, which the revised estimates are assuming. We have to take a commercial break. So Nilesh, just stay on for a bit. We are back in a jiffy.